Namaskar. The Indian stock market is facing one of its worst phases in recent history, with February marking an unprecedented decline. Over 2,500 stocks on the BSE have lost value, surpassing January's downturn and over 3 consecutive months. The advanced decline ratio has remained below 1. This persistent weakness reflects the deep-rooted structural issues and growing investor uncertainty. Yet, the government has taken no significant step to address this crisis. A key concern is the over-reliance on foreign institutional investors, the FIIs, to drive market movements. Since September 2024, FIIs have been aggressively selling, pulling down key indices like I would say Nifty IT or Nifty Pharma. Global factors such as strengthening dollar and tariff concerns have exacerbated the situation, triggering capital flight. But why should Indian markets remain hostage to foreign investors? The lack of domestic investment support and policy inaction have made the Indian economy highly vulnerable to external shocks. Adding to this turmoil, excessive taxation on Indian investors continues to erode the confidence. The securities transaction tax, the STT, and long-term short-term capital gains, LTCG and STCG taxes, create a system of double taxation, making the Indian market less attractive compared to the global counterparts. Most major economies either have minimal or no capital market taxes. Yet, Indian investors are forced to bear an unfair burden. Instead of incentivizing wealth creation and long-term participation, the tax regime discourages domestic investors while allowing the FIIs to dictate the market trends. The failure to implement structural reforms have only worsened the situation. Regulatory ambiguities, weak corporate earnings, high inflation, the geopolitical instability, probably internal and external, have all contributed to market fragility. Despite these warning signs, there has been no concrete policy push to strengthen the domestic participation, to attract long-term investment, or to even boost economic resilience. Investors' confidence is at an all-time low, and without urgent intervention, the crisis will deepen much further. The stability of the markets, the government must take some decisive action, and it is very, very crucial. Reducing STT and scrapping LTCG tax will encourage the domestic investment and level up the playing field. Strengthening domestic institutional investors, the DIIs, including mutual funds and pension funds, will ensure market stability and reduce dependency on the FIIs. A selective erasing of FDI rules should attract stable and long-term investors rather than speculative capital. Additionally, reviving consumer demand through tax cuts and subsidies for essential goods will boost our economic activity. Increased public spending on infrastructure and MSMEs coupled with supportive monetary policies from the RBI will probably enhance liquidity and reduce borrowing costs. The time for complacency is over. The Indian stock market cannot remain at the mercy of FIIs outflows while investors are penalized to excessive taxation and regulatory uncertainty. A bold and investor-friendly policy shift is urgent, and I think, in my opinion, it is needed to restore confidence, ensure market stability, and strengthen our country, India's economic foundation. This is just my opinion. Kindly take it positively. Namaskar. Jai Hind.